Hello students, I hope you all are doing good and fine. So in our today's session, we will be discussing the question number 2 from your ACCS December pre-mock 2025. So this question will include your ethics part. As you know, the question number 2 is from ethics part. And let us start with this. And when coming to ethics, you know that for 8 to 10 marks for sure this question will come. So let us do this. Chalo then. A. Alban Alban is the parent of a group of companies. Okay, Alban is a parent company of a group of companies that generates electricity. Okay, Alban is what? Sir? Alban is a parent company of a group of companies that generates what? Electricity. It prepares its financial statements using IFRS accounting standards. It prepares what? It prepares the financial statement using what? IS and IFRS. Alban has a financial year end of 31st December 2000 XY. So the year end is what? 31st December 2000 XY. So we know what is the year end. Simple. Other than this, nothing required. Nothing is required. Then the following exhibit available on the left hand side of the screen provides information relevant to the question. As per your pre-scene, it will be on the left hand side. The exhibit data. Purchase of Fleetwheel Company provides information about the recent acquisition of a subsidiary. Okay, A is acquiring a company known as Fleetwheel. So F company they are acquiring. Yes, sir. This information should be used to answer the question requirement within the response option provided. So we have to answer it based on the options, a response option which is provided, the word where you can type out. Okay, chalo then. Okay, let us read the requirement so that we understand what all is the question. Okay, using the exhibit one. Okay, we have to use the exhibit one. Explain the accounting treatment. Okay, sir, IFRS accounting treatment for the contingent consideration. Remember, we have done this topic contingent consideration. Sir, we have done contingent consideration in what? If you remember, we have done contingent consideration in your consolidation IFRS 3. Contingent consideration. I'm not talking about contingent liability. We are talking about contingent consideration, deferred consideration, contingent consideration, cash consideration, share exchange, etc. Deferred consideration, what? Payment will be done in future. The price is fixed, the timing is fixed. Contingent consideration, payment will be done in future, but that depends on a future outcome, a performance of the company. Same thing here. So we have to explain that, and we know, sir, contingent consideration is recorded at fair value. Bete, IFRS 3. It's not covered in IS 37. It is covered in IFRS 3. Business combination. Business combination says that contingent consideration should be recorded at fair value, and any change in the fair value should be accounted in the P&L. And you know that the liability we recognize at fair value. Remember, in our consolidation, we had done one question where we had considered the contingent consideration. We calculated the fair value based on probability by discounting it. Yes, sir. And the decommissioning cost. So decommissioning cost means what, sir? Decommissioning cost also we have done better. We have done the decommissioning cost. IES 37, IES 16 provision. We recognize provision, sir. In future, we have to decommissioning it. We have to dismantle the PP because we have a obligation. Either we have a legal obligation or we have constructive obligation. We recognize debit, PP, credit, provision, sir. Yes, sir. Then next one. Discuss the impact of the acquisition of Fleetwheel Company on the draft sustainability report. Okay. Sustainability report is also there for 3 marks. Okay. So that means we are acquiring this company. As we are acquiring this company, what is the effect on the sustainability report? We have to mention it. As we are acquiring this company, what is the effect on the sustainability report? We have to mention it. We have to mention this point. Yes, sir. Then, using the exhibit 1, okay, using the exhibit 1, discuss the ethical issue and outline the actions. Okay, ethics. Discuss the ethical issues and outline the action which saint should take to resolve these. Okay, saint, a person, some or the other person is that, or an individual, we have to consider it. Professional marks will be awarded in part C for the relevance of the ethical principle and action. So we have to write down the relevant ethical principle. We have to relate to the case and we have to write down the actions. Yes, sir. A very easy question. Let us see now. Based on the data, we know contingent consideration is tested, decommissioning is tested, sustainability is tested, and ethics is tested. Chalo then. Saint Saint is an ACCA member. Okay, Saint is an ACCA member. Okay, if he is an ACCA member, Saint is an ACCA member, should follow the code of ethics. ACCA code of ethics will be applicable. and has recently joined Alban, a company. It has recently joined Alban. Her direct line, okay, her direct line manager, Saint, her direct line manager is the finance director. Okay, Lena, who is also an ACCA member. Saint is that. Saint is an ACCA member. Hutch, direct line manager is a finance director, Lena, who is an ACCA member. So both of them are ACCA members here. So if both are ACCA members, the code of ethics will apply. Yes, sir. Then Lena has personally drafted A's consolidated financial statement. Okay, A's consolidated financial statement has been drafted by Lena, as she is an ACCA member as well as finance director. Yes, sir. Then for the year ended 31st December 2005, for 31st December 2005, they are making the consolidated financial statements. Yes, sir. Saint Saint's first major task is to review these statements before the external auditor arrives. Okay, Saint is an ACCA member, so she has to do what? She has to review the financial statements before the external auditor arrives. So if there are any changes or if there is any omission of any IS or IFRS or any misinterpretation of any IS or IFRS, any wrong treatment is there, she should mention. Yes, sir. Saint has paid particular attention to the sustainability report. Okay, Saint has paid particular attention to sustainability report, and you know in sustainability report what are the two important things? IFRS S1 and IFRS S2. Yes, sir. Two, and to consolidation of the Fleetwell company, a subsidiary acquired in November. So we have acquired this company in November. So S is focusing on what? S is focusing on the sustainability report as well as the consolidated financial statements, as well as what's a consolidated financial statements. Fleetwell company, Fleetwell Co. operates a coal furnace. Okay, operates a coal furnace. The business coal furnace, the business model of the group prior to the acquisition of Fleetwell Co. was the operation of wind and solar panel farms to generate clean electricity. See here. A very important point regarding sustainability we can see here. Fleetwell company, with the company which we have acquired, is operating a coal furnace to generate electricity. But before acquiring this subsidiary, we were generating electricity with the help of wind and solar panels. And at that time, we were generating clean electricity. So we were generating clean electricity. Was there any issue regarding sustainability at that time? No issues was there regarding sustainability. Now, as we have acquired the company, there is a issue regarding sustainability. There is an issue regarding what? There is an issue regarding sustainability. Simple. So previous year the subsidy was not acquired. This year we are acquiring. Now there is a major change in the business model of the group because we have acquired a company which operates in coal furnace to generate electricity and creates some problem for sustainability. We have to disclose the risk and opportunities. Is the risk here, not opportunities. Risk. Then we have to mention the risk, how we will overcome this risk, what is our strategy. All this should be mentioned. Yes, sir. Then Saint has reviewed the draft Alban company consolidated financial statement and the accompanying sustainability report. So S has reviewed what? Saint has reviewed the CFS as well as sustainability report. While the content appears appropriate, S had made the following observation. Okay, she has mentioned that okay, we have it is appropriate, no such issues in that. The the sustainability report and the CFS are appropriate, but some observations are there. Some of the other thing are wrong. Let us see now. Now let us see. Let us see. Chalo then, sir. Sir, contingent consideration. I hope everyone remembers contingent consideration is as per IFRS 3. And sir, we should record it. We should record it at fair value. Simple. Yes, sir. See now, contingent consideration. The purchase agreement of F, that is Fleetwell, the purchase agreement of Fleetwell company, that means Alban is acquiring Fleetwell. In that agreement, what is mentioned? Include an earn out clause requiring Alban to pay additional cash consideration. Yes, additional cash will be paid if Fleetwell company achieves specified future profits. Yes, sir. It is based on a future outcome. Yes. it is based on a future outcome. If it is based on future outcome, what will happen, sir? If it is based on future outcome, what will happen? The investment in Fleetwell company has recorded by Saint. The investment in Fleetwell company as recorded by Saint does not include the contingent consideration. See now, does not include the investment of Fleetwell company, which include the purchase consideration. In that purchase consideration, Saint is saying that it does not include contingent consideration. Now you only say, if it does not include your contingent consideration, what will be the problem? What will be the problem? Sir, purchase consideration will be understated. Yes or no? Purchase consideration is understated. Your goodwill also will be impacted. Yes, sir. And this is not recorded by whom? Does not include this purchase consideration. Lena has noted that this is justified because it seems improbable that Fleet will company will achieve the specified future profits for the additional consideration to become payable. Okay, Lena has noted that it is justified that it is improbable that the targets will be achieved. But remember one important point. IFRS 3 says what contingent consideration should be recorded. Here, the recognition is not based on the probability of the amount which we are paying, but we have to recognize. Recognition will not be affected. And understand, Lena is the senior manager, senior, and junior is who? Saint. So, can I say I can link this with ethics also? Intimidation. When I come to ethics, I'll write down intimidation threat. And here, the accounting is as per the old IS, but IFRS 3 has updated that the contingent consideration should be included so that true value or the faithful representation is that. So now here one more thing I can say professional competence and due care is compromised. Why professional competence and due care is compromised? Because they have not recorded. Lena has not recognized the what we say your contingent consideration. Even though she is an ACCA member, she should record it. She should be updated. Yes or no? She should be updated. Yes, sir. But she have not recorded it. Create a problem. Yes, sir. Any doubts in this part? I hope a very easy part. Now, what they have mentioned, we have to discuss this. Sir, as per IFRS 3, we have to recognize it better. At fair value, any difference in the fair value will go to P&L, not in goodwill. The purchase consideration is understated, goodwill is understated. So they mention the correct accounting treatment. Write down the correct accounting treatment. If you correct this, what all will happen? Simple, easy marks. Simple, easy marks. Yes, sir. Then coming to the next part. Okay. Okay, the first requirement was for both the things. Okay. Let us see what are the points I mentioned here. See now. It is part of IFRS 3. As per IFRS 3, business combination contingent consideration should be recorded at fair value. Yes, sir. Should be recognized at fair value. One simple point. It is not covered in IS 37. Then, record at fair value. Probability of payment affects measurement, not recognition. See, very important point. When coming to the probability of the payment, it affects the measurement part, whether the fair value will be low or high, but it does not affect the recognition. We have to record it as a contingent liability. Yes, sir. Fair value changes to P&L. Also, we have to provide disclosure. Excuse me. As this is a contingent consideration, the fair value changes will go to P&L. We also have to provide disclosure regarding the risk, its nature, and effects on the CFS. Yes, sir. This also we should provide. Then understate goodwill and purchase consideration. As we have not recorded this, we have to recognize this. If we have not recorded this, will understate goodwill and purchase consideration. A very important. So these are the 4 points. If you write on 4 marks, but let us see the solution which they have written. See now, so many points they have mentioned. It's not possible to write, but let us discuss this so that you have a brief idea or a good knowledge about the standard again. It's a revision, see now. Contingent consideration. Under IS 37, provision, contingent liability, and contingent asset, one of the recognition condition of provision is that the outflow of economic benefit must be probable. However, IAS 37 is not relevant in this. Yes, sir. Even though you have not mentioned this point, it's okay here. But IFRS 3 is updated. I mentioned as per IFRS 3, we have to recognize it. The acquisition of Fleetwell company is a business combination, and therefore IFRS 3 business combination applies. Under IFRS 3, the cost of investment must be measured at the fair value of the consideration transferred. Okay, this 1 marks. I will mention this point that it is as per IFRS 3, not as per IS 37, and it should be recognized at fair value. Simple. Sir. Then, accordingly, the probability or possibility of the additional payment is a measurement issue, not a recognition issue. Yes or no? Yes or no? Yes, sir. The probability or the possibility of the additional payment, the payment which we do based on future, is the measurement part, not the recognition part. Not the recognition part. Yes, sir. Therefore, it is technically incorrect that the cost of investment in the subsidiary. Okay, they mentioned that it is incorrect technically. Fleet will does not include an estimate of the obligation in respect of the additional payment. It should be recognized as a financial liability. Fleet will company has not recorded this uh, does not include the estimate of the obligation. So when we do CFS, when we calculate goodwill, we have to include this value. This should be recognized as a financial liability at fair value at the acquisition date, regardless of the low probability of the payment. Sir. Yes, sir. As a result, the investment in fleet will is understated, and so it is the measurement, and so too is the measurement of goodwill in the CFSC. One more this point, the 4 points which I mentioned, you write it's enough, but here we are reading so that we get a idea, sir. Okay, these all are the points in detail we get to know. Subsequent changes in the fair value are recognized in the profit or loss, so later adjustments will not impact the measurement of goodwill. I mentioned this point. Mention the wrong thing, then mention the right, and what is the subsequent thing. IFRS 3, IFRS 7 have disclosed requirements for the nature risk related to contingent arrangements. Yes or no? We have to disclose, including key assumption and potential future payments. I mentioned you. We have to provide the disclosure regarding the risk, what is the nature, what are the assumptions we have taken into picture. All these are the things which you have to mention in your answer. 4 simple sentences mention it's not as per IS 37, it is as per your IFRS 5. Then what will you mention? Then one more point what we can mention is that we should recognize that fair value. So the probability or possibility of the payment will affect the measurement, not the recognition. It is recognized at fair value as a financial liability, and subsequently it is recognized at fair value, and any difference will be taken to penal, not to the goodwill. So your goodwill is understated and the purchase consideration is understated. Yes, sir. Now coming to the next part, decommissioning part, the decommissioning cost. So as I mentioned, decommissioning part. Decommissioning cost says what? Decommissioning says that we should recognize this as an asset today and a provision. This asset will be depreciated over the useful life, and this provision at each reporting date we have to unwind it. We have to do unwinding finance cost as records. Decommissioning cost in its individual financial statement. Okay, in its individual financial statements, fleet will company made no provision for the decommissioning of its coal furnace. Okay, sir, in separate books only they have not done. In individual financial statements, they have not recorded this. If they have not recorded in the individual financial statements, can I say we should recognize this in individual financial statement? Yes, sir. Sir, when we do consolidation also, we have to recognize, yes. When I acquire any company, when I acquire a subsidiary company, we acquire at fair value of the asset, and that fair value of the asset should include the decommissioning cost. Yes, sir. Your step number 2 calculation, but we have to explain the accounting treatment here. Okay, again I can say professional competence and due care, etc. So Lena is not properly recording the IS and IFRS. So her intention could be something we have to see. Whether she's getting any payment based on any profit figures, etc. XYZ. Let us come to that later. Lena has noted that this was correct because there is no legal obligation. Arre bapre. Okay. There is no legal obligation, and no present obligation. Okay, Lena is saying no legal obligation, no present obligation. Now, a question to everyone. If today I have a furnace, if I'm using that, it creates a present obligation. When, sir? When we have to dismantle it. Let us see. As per the contract, and no legal obligation and no present obligation. Lena is saying, okay. As the coal furnace are expected to operate for another 10 years. Okay, they are expected to operate for 10 years. However, Fleetwell Company has decommissioned similar furnace in the past, incurring cost to do so in an environmentally responsible way. So they have already, fleet will company has decommissioned a similar furnace in the past, incurring cost to do so that they protect the environment. Now see me, even though there is no legal obligation, but what is that? Even though there is no legal obligation, that is what? Constructive obligation is there, sir. Constructive obligation is there. So this is wrong. Even though legal obligation is not there, we have constructive obligation. One simple point, because fleet will company has decommissioned similar furnace in the past, incurring cost to do so in an environmentally responsible way. They have done to protect the environment. So here Lina is again wrong. Can I say she is not updated as per IAS 37? She has no good knowledge. Again, professional competence and due care. So what could be the action? In my mind, an action comes that she should be updated with the knowledge. Now if you're an ACCA affiliate, you become an ACCA member. After that also we have to update ourselves whenever there is a change, whenever new IS or IFRS comes into picture. So we have CPD, continuing, what is that? You have, once you become a ACCA member, you have to do CPD every year. Continuing professional development every year we have to update ourselves. Understand that? Yes, sir. So this is also wrong. Now what are the points I'll mention simple points that I will write down the technical knowledge of provision. Provision is what? Provision is a present obligation, legal or constructive, as a result of past event. Probable that future economic outflow will be there, and reliable estimate. Then provision should be recognized here because constructive obligation is there. Even though fleet will company mentions there is no such legal obligation for fleet will company, but there is a constructive obligation, so a provision should be recorded. So provision is recorded. How, sir? It's recorded at the fair value and added to the cost of the asset. Cost of the asset, that is PPE, with PP coal furnace. Yes, sir. Then recognition of both PP and recognition of both present value of the provision. We have to recognize the provision at present value and in the PP in individual books and CFS, that is your separate financial statements and consolidated financial statement. We have to record it. Yes, sir. We have to record it. I hope this is clear to everyone. A very easy part, huh? See now, they have written so much. The content is huge. If you have just written 3 points, as mentioned, I've given 4. If you have written 3 points, it's done. See now. The financial statements of Fleetwell are incorrect as the provision should be made for the future cost of decommissioning the furnace. All three conditions of IAS 37 are met as there is a present obligation probable outflow that can be estimated reliably. There is a present obligation because the furnace are currently operating. As mentioned, it is currently operating. Even though we sell tomorrow, we have to incur that decommissioning cost. This is a past event which creates a present obligation. While there is no legal obligation to decommissioning, Fleetwell has, by its past actions, raised a valid expectation that it will continue to decommission furnace responsibly. So they have done what? Based on their past actions, it has created a valid expectation they will decommission. They will decommission. Then, and this creates the constructive obligation. See, it creates what, sir? Constructive obligation. Yes, sir. The provision will be measured at present value, reflecting the time value of the money and included in the cost of the furnace in accordance with IAS 16. That is property, plant and equipment. Yes, sir. I mentioned this. Correcting this omission will result in recognition of both asset and liability in the Fleetwell individual financial statement as well as in what? CFS, consolidated financial statements of Alban A company. Yes, sir. Then, correcting this omission will also result in the liability increasing due to the unwinding of the discount, yes, sir, which is recognized as an interest expense in P&L. This also is an important point, better this and this. As I mentioned, when coming to ACCA, the question was for 7 marks, but examiner will evaluate this assuming that the question is for 8 to 9 marks. Understand that. The increase in the cost of asset will increase depreciation expense. As I mentioned this point. Yes, done with this. So 7 marks easy requirement. 7 marks we had easy requirement. Yes, sir. So with this part is done. So the first 7 marks requirement is done. Now let us see the other part. Then discuss the impact of the acquisition of Fleetwheel company on the draft sustainability report. Okay, let us see the sustainability report what they have mentioned in this. Sustainability report, you know कि sir Alban is a group company which was producing electricity through wind and solar. Now they have acquired this Fleetwheel company. In that case, what will come into picture? Sir, it is using coal furnace, so pollution will be there. So sustainability will be a major part now when compared to previous year. Alban sustainability report for the year ended 31st December 2004 complied fully with both IFRS. Okay, they are saying what Alban report for the year ended 31st complied with fully both IFRS S1 general requirement for disclosure of sustainability related financial information and IFRS S2. They are saying that okay, S is saying that A's financial statements have complied. But let us see. The draft sustainability report for the current reporting period is largely based on the prior year. They are saying what? This is based on current reporting period is largely based on the prior year's content. The current year sustainability report which you have prepared, it is based on the previous year content. Now previous year this company only was not there. If the company was not there, this subsidiary was not there, in that case the sustainability reported disclosure are incomplete, because now we have a major change in the business model and does not reflect the acquisition of Fleetwell company. So this F company, this sustainability report does not include. But when we prepare IFRS S1, S2, when we follow IFRS S1, S2, we prepare sustainability report, and that sustainability report should reflect current conditions, the current disclosures of the entity, but they have not done. Again a problem. Again a problem here. Yes, sir. Again, a problem here. So ethics also we can link this. Yes, sir. Then they mentioned discuss the impact of acquisition of on the draft sustainability report. Now we have to mention what is the problem here. One simple problem. What is the first problem we mentioned? That as we have acquired the company, we have to do what? We have to follow, no? If we will not follow, what it will create? A problem, sir. It will create a problem, bete. Chalo then. Let us see. Some points are written. Yes, sir. Change in business model. Yes or no? There is a change in business model. So change in business model, we should update the sustainability report. What should we do, sir? We have to update what, sir? We have to update the sustainability report. If not, it will create a problem, because now it is a carbon intensive operation. Yes or no? As we have acquired the company, it becomes a carbon intensive operation as per the coal furnace which is operating. Yes, sir. Then IFRS S1, S2 disclosures, risk strategies, and copying last year report will be misleading. We have to mention that as the model has been changed, as per IFRS S2, disclosure requirements should be done properly, like what are the risks, how will the company overcome this, etc. And copying the last year targets will be misleading. So again, here integrity comes into picture. Yes, sir. Then new target should be set, as we have acquired a new company and it totally has a different business, totally a different way to produce the electricity which is harming the environment. And as well as we should identify the important risk, also monitor them, and we have to mention what are the financial impacts because of this acquisition. Yes, sir. Chalo then, let us read the point which they have mentioned. Okay, see, so many points they have mentioned, but we have to mention the three important points which I mentioned. What are the 3 points? Mention that there is a change in the business model. So whenever change is there in the business model, what should I mention? What is the important point we will mention? The important point is that the acquisition of Fleetwheel company will affect the sustainability report. So what we will include in this? So we will include this in what? We will say it is now a carbon intensive operation. So there should be updates in the sustainability reports. Updates should be there. So chalo then. The acquisition of Fleetwell, which operates coal furnace, represents a major change in the A's clean energy business model. This should have a radical impact on the sustainability report in that IFRS S1 S2 requires sustainability disclosures to reflect the current activities, risk and strategies. The report should be updated to reflect the group now more carbon intensive operation as mentioned to you. It is not acceptable simply to copy the content of last year report because the information would no longer meet the IFRS S1 requirement to provide entity specific updates. Yes, it will not provide entity specific updates. Yes, sir. Using prior year, it will be misleading. Then there has been a change in the strategy of the group, and it will be necessary to identify the new sustainability risk rising from the operating the coal furnace. These risks needs to be described in line with IFRS 2, including an explanation of the affected financial effects and relevant time horizons. So the financial impacts also we have to mention. Then some, the operation of coal furnace will bring with it new risk. Alban is required to disclose how these risks are monitored, managed, and mitigated in accordance with IFRS 2. The previous metrics and targets of the group relating to climate related disclosures were presumably very positive given it was generating clean energy. It was assumed, we can see that it was into green business, the targets were totally different. Now it will be totally different. These will need to be re-evaluated now that the group is operating coal furnaces, since IFRS S2 requires entities to disclose performance against climate targets and to revise them when business circumstances change materially. Here, materially, the business model is changing, so we have to change it. As I mentioned, 3 points, not more than that. The content is more here. Important point, saying that the report should be updated. It will be misleading. Then new risk and opportunities are there. How we should monitor, etc. The targets also will change. The change in business activity may also affect what is material for the disclosure purpose. Under IFRS S1, information is material if omitting or misstating it could influence a decision by users of general purpose financial reports. The sustainability report must explain how governance body, example the board, oversee climate related risk and how the group strategy is adapting to reflect its new exposure to carbon intensive operation. As well as we have to mention how the body, the governance, which body in a company, that should be a board which is working on the sustainability, how they will overcome this, what are the strategies, each and everything we have to mention. Yes, sir. So with this, the second part is done. It was too long, but as I mentioned, write down the three important points. That is, the business model is changing, so the report should be updated. Then I say IFRS S1 and S2 says that should reflect the current operation of the companies, not to copy the previous year thing. Then we have to mention all these points. A easy part. Then what we can mention, sir? Then what are the points we can mention? The easy point is then what, sir? That the targets and metrics are changed. We have to update it because IS and IFRS says that there is a material change in the operation of the company. Yes, sir. Chalo then, the last requirement for ethics, sir. A very important part. In the important part, what they're saying, using exhibit 1, discuss the ethical issue and outline the action which S should take to resolve. So how should S resolve this? Now you only say, can I say S is the junior and senior is there? So can I say intimidation threat can be there? So S should be careful, Saint should be careful. Lena is the senior, Saint is what, junior, so S should be careful. That one point. Then professional competence and due care, I can mention that Lena does not have, both are ACCA members, huh? So professional competence and due care is compromised because the accounting treatment is not done correctly as per IAS 37 and IFRS 3. Both the things. Yes, sir. Then what we can make? Yes, both the things we can mention. Then integrity, yes, yes or no? Integrity. Here, the sustainability report, yes or no? Is in problem. Yes, because each and everything, because they are saying they have copied from the previous year. Integrity issue, they are not being honest. Yes, sir. And who is reviewing this? Saint. These are the issues which Saint has identified, and integrity is compromised. Then what are the other things? What are the actions we can say here? Action can be what? Your actions can be that Saint should document what all are the issues and should present this in a professional manner to Lena because she's the senior. Yes, sir. Then I can say then Saint should do what? If Lena is still not okay with the change, then a saint should disclose this matter to the higher authorities, and she should considering resigning. That is the last option. Then you will write at last. Then what is the other thing we can say? Then can I say continuing professional development should be the CPD program should be attended? Yes or no by Lena? All these points are the actions. Chalo, now let us see what are the points they have mentioned here. And when coming to S, Saint also must behave professionally, should not be influenced by Lena. That is also important. Ethics, yes, chalo now. Saint and Lena, the finance director, and Lena, direct line manager, are ACCA members. So both should be well aware of the ethical code which is given by ACCA. With this requirement for competence and professional behavior, they are not behaving professional. That also. See, competence. It is concerning that the draft financial statements prepared by Lena containing such fundamental accounting technical errors in the application of IS and IFRS. In addition, the sustainability report, yes, both the things are there. There is a problem in IS and IFRS as well as sustainability report has not been adequately prepared to reflect the changing nature of the A's group business. As the group is changing, we have to reflect it. They have not done this part. Then the initial conclusion is that Lena has simply made mistakes and not exercised due care and is therefore incompetent. Competence and due care is compromised here. Now, what are the reasons? The reasons could be that what competence is a fundamental principle in the ACC Code of Ethics and Conduct, which requires member to maintain professional knowledge at a level required to ensure that client or employees receive competent professional service. This will carry 1 marks, technical marks regarding professional competence and due care. This applies not only to the preparation of financial statement where Lena has applied IFRS 3 and IAS 37 incorrectly, but also to sustainability report such as those required under IFRS S1 S2. So it's nothing. They have mentioned that the compromise because of the fundamental accounting technical errors made in what accounting. Both the things. Then you mention what does competence means as per this one. You'll get marks. Yes, sir. With this is done. Then integrity. Why will say the integrity is compromised? An alternative possibility is that Lena had made these errors and omission deliberately. The possibility could be that she has done this deliberately because she would have been motivated by any personal gain. Yes, sir. This would show a lack of integrity and be a far more serious breach of professional ethics. However, there is no circumstance evidence to support this argument. There is no such argument which help us to give a clear point of view. Okay, that integrity is compromised, but we can say that self-interest threat could means no self-interest threat, but we can say what we can say that professional your integrity is compromised because some or the other personal gain can be that is the reason she have done this. If knowledge is not there, then professional competence and due care. If this is done deliberately, integrity is affected. Now, then S must remain alert to the possibility of intentional misstatements. So, Saint must be alert for the possibility whether this is done by Lena intentionally or not, especially where there may be incentives, example, performance related pay or pressure to meet targets that would compromise objectivity or integrity. Yes, so Saint as a junior, she should be what alert whether this is done intentionally or not for her personal gains or to get any bonus related pay, etc. So these are the points which you have mentioned easily. 1 marks for sustainability, 1 marks I say for this IFRS 3 and this, and here you can easily score 3 marks writing the professional competence. Here this 1 marks because saying relating to pay, and S should also be what? S should also be in an alert. Yes, sir. Actions. Yes, sir. What are the actions? See, they have written a lot of actions, but we need only 2 actions, 2 to 3 actions. 3 actions are enough to get the marks. 3 actions are enough to get the marks. So what we will say, see now, S should prepare well for the meeting and behave professionally. Acting in a professional manner is a fundamental principle of the ethical behavior. Yes. Then see the task of communicating concerns to L that the draft financial statements and sustainability report she has prepared contain technical error will be a sensitive one because this is the first task that S has been assigned in her new job and L is her boss. So what are the actions? As I mentioned, what is the first action we say? Saint should mention what? Saint should document this properly and must be prepared for the meeting in a professional manner, and she should mention to Lena that this is wrong, we have to correct it. Okay. As a new member of a staff, S may feel under pressure to confirm or avoid conflicts. Then, especially given Lena is her direct line manager. So it's a pressure that it's a new day, it's the first job, and a pressure is that ki, how will I talk with my senior, etc. XYZ. Yes, sir. Then what is the next thing? This situation represents a self-interest or intimidation threat to her objectivity. Yes or no? For a saint, it will be what, sir? For saint, it will be what? It will be a intimidation. She will feel that okay, there is a pressure on me. Simple. Yes, so this part is clear. So we have mentioned under pressure to conform or avoid conflict of interest. We have mentioned preparing appropriate documentation to support her criticism is important to justify her concerns. It is very important that she prepares proper document to verify herself, to verify and to justify. It's important that she justifies the whatever mistake that L has done. Yes, sir. Then this no need. You have written. See what I mentioned. This is the first point. Then one intimidation. Oh, okay. If you have not written this, also no issues. But should be professional in a professional manner. Yes. Then I say what this one, this one, CPD programs, a very important part. CPD programs. Yes, sir. See, you know. S should also suggest to L that she should reflect on her need for continuing professional development to make sure that she is technically up to date. A sensitive conversation to have with a new boss, S might frame this diplomatically, for example, by suggesting a share CPD review or referencing recent updates to IS and IFR. It will be very difficult that you are a junior and to your senior you are giving some advice. As you know, in corporate world also, if we give advice, they'll never take it. So these all are the problems. You can mention simple this one, CPD programs, so that Lena is up to date. Yes, sir. After this, what we can mention here, then assuming that Lena acknowledges the end need to correct the financial statements, undertakes training, and has established an effective work relationship with her, no future actions will be required. Yes. If everything is good, Lena will say, okay, these are the mistakes, we will correct it, and I will undertake a training program. Then there will be no such other conflicts. If not, conflicts will be there, no? If not, conflicts will be there. A lot of conflicts will be there. Yes, sir. Yes, sir. So with this one marks, you can mention this one and one. And what is the one more point we can mention that I can mention about the intimidation threat. Yeah, we have mentioned that as a new staff, what should S do? What should S do? S must be careful regarding the interpretation. See, a saint has intimidation threat, so she should be careful. Yes or no? She should be careful and should try to maintain objectivity. Yes or no? She should try to maintain objectivity. These are the points which you can include. So, with this, your discussion regarding the question number two is done. I hope the question was easy. When you see the answer which is given by AC is too long, but I mentioned you for these, write down these simple points, you will get marks. And for ethics also, I mentioned the competence linked to IAS, IFRS 3, IS 37, then linked to sustainability report done. Integrity mention about that this is done deliberately to get some. Then S should be what? Aware enough. S saint should be alert, etc. Then coming to action. What are the actions I mentioned? S should document properly so that she can criticize and she can justify what is right or what is wrong. Then we can say S must recognize that there is an intimidation threat and she should be careful. Then what we say, she should propose corrective action should be taken. If L is taking corrective action, then no such issues. If L is not taking corrective actions, then saint should try to communicate with higher authorities. Yes, sir. All these are the points which we can include. And then if L refuses to correct the answer, the errors, we mentioned that we can communicate to the higher authorities. If higher authorities are also saying no, then S should consider to resign. Simple. Yes. So with this, your section B part is done. So I hope with this you have you got an idea how to answer this question, and you got a detailed knowledge regarding IFRS 3 and IS 37 again. So with this, the other section, the consolidation question, the question number 3, question number 4 is uploaded. You can watch it. So with this, bye bye. Have a good day. Signing off. Radhe Radhe to everyone. All the best for your exam.